All right, let's dive right in. In this explainer, we're going to walk through a really unique method of market analysis called market DNA. We'll be looking at a real case study on the S&P 500, and the whole point here is to document every single step so it can be publicly verified. So let's see how this thing works. So, what exactly is market DNA? Well, it's described as a proprietary geometric system. It's all about shapes and structures. But here's the real kicker. What makes it so different is everything it doesn't use. The model completely ignores traditional indicators, so you won't find any technical, fundamental, or quantitative analysis here. It's presented as a purely geometric approach, and that's it. So here's our game plan for today. We'll kick things off with the entry plan, which is called Phase 1. Then, we'll look at the risk and return that were projected from that plan. After that, we'll see what actually went down, and what the model calls a Phase 3 event. And finally, we'll wrap up with the current status and, of course, some very important disclaimers. All right, let's get into it. Phase 1, the entry plan. What you're seeing here is the initial blueprint for this specific analysis. It was all documented and set in stone back on February 1st, 2026. Now, looking at the chart, you can see the model zeroes in on two specific price levels for a potential entry. The first one is called level M, and that's the primary entry point. The second is a backup, a secondary entry point, labeled P, C. So right from the start, these were the two exact levels the plan was built around. Now, before we jump into the hard numbers, this is a really key concept to grasp. The entire strategy is built on a foundation of predefined parameters. These aren't just numbers pulled out of thin air. They're the core building blocks that shape the whole plan and, crucially, the risk management right from the get-go. Okay, let's break down the specific parameters for this trade plan. The primary entry, M, was set at 6,857.39. The secondary entry, PC, was a bit lower at 6,799.97, but there's more to it. The plan also has these key risk variables. There's a trapezoid time duration of 25 days, a third triangle domain of 2.32%, and a risk coefficient of 2. You can think of these as all the ingredients that go into the model's calculations. Okay, to make the risk part of this a little easier to digest, the rest of the math is based on a hypothetical starting capital. For this case study, we're just going to use a round number, $100,000. So using that hypothetical 100 grand, here's how the risk was laid out. The absolute maximum allowed loss, or drawdown, was capped at 5%, which comes out to $5,000. So based on all those parameters we just saw, the model calculated a total position size of 1.58, and that would be split into two separate trades of 0.79, but only if both entry points were actually triggered. And just to be perfectly clear, the documentation is very specific here, so I'm going to read this next part verbatim. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. Okay, so we've covered the setup and the risk side of the coin. Now let's flip it over and look at the potential upside. This next part of the plan details the predefined price targets for this cycle. So the plan laid out three very specific targets. First up, target 1 was the mirror level, sitting at 6,874. Next, target 2 was a key point called apex N, projected at 6,937. And the final target, T3, was the trapezoid top, all the way up at 7,009. So what could that mean in terms of actual profit? Well, the plan outlined two possible scenarios. Scenario 1, if only the first entry at level M got triggered, the expected profit was just shy of $1,200. But in Scenario 2, if the price dipped and triggered both the M and the P entries, well, the expected profit was much higher, at over $2,000. Okay, so that was the blueprint, the entire plan laid out in Phase 1. But plans are one thing, what actually happened is another. So let's fast forward to February 2nd. This is what the model calls a Phase 3, or an N-level event. And boom, here's the updated chart. You can see the market moved up and hit 6,937. Now, if that number sounds familiar, it should. That's the exact price level the model had predefined as apex N, which, you'll remember, was also target 2 from our initial plan. Now, this is where the model's structure gets really interesting. This event, hitting the N level, is classified as Phase 3. The key thing to note is that this happened before what the model would have called Phase 2. See, phase 2 would have been triggered if the price had hit a different geometric line first. So this shows that the phases aren't always a simple 1, 2, 3 chronological order. So let's do a quick play-by-play of what happened. First, the initial position was opened at that M level, but the price never dipped back down to hit the secondary entry at PC. Instead, it rallied straight up to the N level, which completed what the model defines as phase 3.
And that brings us right up to the present moment for this documented case study. So let's wrap this up with the current status of the analysis and those important disclaimers.
The documentation for this cycle pretty much ends on a cliffhanger. It leaves us with this open question: will the next phase be phase 2? The report simply says, we are navigating the market to see what happens next. And as of right now, that's where the public record of this analysis stands. And finally, before we go, we need to cover some crucial disclaimers. Please listen carefully. This is not financial advice. The model specifically prohibits using leverage above 10. You should never, ever invest essential personal funds. This analysis is simply part of public model documentation, and it's for verification only. And, most importantly, any risk management must follow the user's own specific instructions. Thanks for tuning in.